Hi, good evening, everyone. Welcome for today's webinar. I hope all of you all can see me and hear me clearly and well. Most of us have joined the webinar, so let's go ahead and start today's webinar. Before we start out, I just want to do a quick poll just to understand what level of technical analysis you belong to. Please feel free to just select the poll that you feel you are best suited for. Basically, how much like the question is actually wrong over here. It says how well do you understand the financial markets, but just change the question to how good are you with technical analysis. Are you a beginner, are you intermediate, or are you advanced? So I'm just going to start the polling. Please note again, the question is what level of technical analysis do you feel you belong to? Are you a beginner, intermediate, or advanced? Right, we'll just wait for a couple more of you to do the poll. Again, you can change your answer. I'll just repeat this one more time. The question is, what level of technical analysis do you feel you belong under? Are you a very new technical trader, or have you been trading a little bit, or are you advanced technical analyst? All right. I think I've got most of the answers. Most of you all have responded. Thank you. So most of you all belong in the category of beginner and intermediate. So let's start off this session again. It is going to be quite easy to understand, even if you're very new beginner to trading or investing in the markets. But at the same time, I hope to add more value to the ones who are already experienced in trading based on technical analysis. The topic for today is how to find high probability trades with Fibonacci and using RSI. Of course, the two tools that we're going to be focusing on today is Fibonacci and RSI, and I will also be adding ATR along with it. Let's move forward. Um, I also would like to encourage you all, if you like the webinar, if you like the session, please give us a review on Google. If you have any feedbacks, if you have any other questions, if you have any suggestions for me, please feel free to write in the comment section. And as we progress, if you have any questions, please feel free to write in your Q&A or in your chat so that I will try and answer as many questions as possible. All right. So, for those of you who do not understand technical analysis, let me make it on a very simplified version of what technical analysis is. When someone is investing in the market or trading in the market, there are two types of analysis that they look at. One is the fundamental analysis, the other is the technical analysis. Fundamental analysis deals with everything to do with that particular company or the stock or the commodity. For example, let's say you're looking at Apple, you do a fundamental analysis on what type of business does Apple have, and you do analysis on their financials. So how profitable have they been in the last 2 quarters, last 4 quarters, last 1 year, last 2 years, last 3 years, last 5 years. So this comes under the fundamental analysis. What kind of prospect do they have in the future? So all these come under fundamental analysis. But when you look at technical analysis, technical analysis focuses on purely the price of the particular stock or the particular commodity or any instrument that you are trading on. Now, if you're looking at a particular stock, you would notice that the stock might be ranging between two prices for the last couple of 6 months. So the behavioral pattern of this particular price movement is something that you see on technical analysis. You see, for example, let's take a stock A is trading between $10 to $20 for the last 6 months, and you see the price going up from 10, it goes to 20. Then a couple of weeks later, you see the price come back to 12, and then again it goes back to 20, and then a couple of weeks later, you see the price come back to. So let's move forward with the technical session. Again, sorry about the delay. So the first technical tool that we're going to be looking at is the average true range. Again, to put it in very simple words, what does ATR do for us? Basically, ATR is a technical indicator that helps us measure how many dollars can a specific instrument move. For example, if you're someone who's looking at gold price movement, you would like to know how many dollars can gold move in a single day. Now, please note that when I say how many dollars it could move, it will not give us a signal in terms of the direction of the movement. The gold can move either direction, but it'll give you on an average how many dollars it can move in a day. Now, if you are someone who is an investor and who is looking at a longer time frame, you can also look at how many dollars gold can move in a single month or in the next 6 months. What is the average movement expected in the next month based on the last 6 months movement? So that is what ATR is going to help us with. I will also show you why ATR is important, or it is crucial when you're taking your trading decision. Once we go onto the live platform, it'll help us keep your take profit. It will help you keep your stop losses. It'll help you measure how much of distance that you can expect a particular instrument or a particular product can move in your favor. Now, as an example, if you can see on my screen, there's a particular chart. It is SPX 500 on a monthly time frame, right? If you go to your technicals, for those of you who have not used the platform before, do not worry. You can take a demo from us later. For the ones who have already been using the platform, I'm sure you're aware of the charting. If you're not, please get in touch with your consultant and they will help you and guide you with this as well. For now, I'm looking at S&P 500, that is the top 500 stocks of US, which is put into one basket. Rather, it's called an index. And I'm looking at a 1 month time frame. That means each candlestick represents 1 month move. Now, if you go to technicals at the bottom, you click on technicals, you get this window open, you go to studies, and you get your ATR. ATR again stands for average true range, and you click on ATR. It will open a separate window at the bottom which shows the ATR movement as of every month. Now, S&P 500 as of every month at this point in time is moving about roughly $236 to $300. Whereas if you look at the same SPX probably back in 2010, every month movement was roughly about $80. So it has progressed over time. That means the number of dollar movement on SPX has increased. And at this point of time, if you are an investor who is looking at a monthly time frame, and if you want to look at, or if you want to see how many dollars SPX can move, you can look at the ATR on a monthly time frame. But if you're someone who's trading and you want to understand how many dollars SPX can move on a shorter time frame, probably you will change this time frame from 1 month to a shorter time frame. Now we'll come back to ATR again in a little bit, and we'll look at how ATR is used and why it would help you in analyzing a particular instrument and how it will help you to keep your take profits and stop losses. Now coming to relative strength index, as the name suggests, it shows the strength in the market. There are two types of strength that we see in the market. That is obviously the weakness in the market, or you see the strength in the market when the market is moving on the higher end. In RSI, basically you look at overbought conditions and oversold conditions. Oversold conditions are when the prices have been sold off, where you see a particular price moment has been dropping and has reached oversold level. Whereas on the other side, if the price is moving up, you will look at overbought position. Now, RSI is also known as an oscillator indicator. An oscillator is something that moves between two ranges. In this, it is going to be moving between 0 to 100. I will show you a couple of live examples on RSI as well. Again, coming to S&P 500, if you go to technicals, you go to studies, you get your RSI in your studies. Now, there are a lot of indicators which we will not be going into each one of them. Today, we'll be focusing on RSI, ATR, and of course, Fibonacci. Now, once you click on RSI, you get a new window again that opens at the bottom of your chart, which shows you the RSI. Like I mentioned to you, RSI is an oscillator, meaning it oscillates between 2 points, that is 0 to 100%. And the 0 to 100% also has been classified into two categories, where Once it is above 100, sorry, above 70%, that is where it is known as overbought region. And once it's below 30%, it is known to be on the oversold region. Now, typically, when the market goes above the overbought region, you will see the market tends to slowly start weakening. And again, one thing to keep in mind is it is not always going to be the case when the market is above the overbought region, it has to come back down. There is no set rule, but it shows where it can be over extremely overbought, so that sellers would probably look at taking profits, or short sellers would look at shorting the market at that point of time, and vice versa. When the market drops deeply, when it is at oversold territory, or once it comes to oversold region, you would expect the buyers to come back in, because they're getting it at a much discounted or a value price to buy back into the specific instrument. In this case, in this example, you see once it had reached the overbought region, it still continued going up. It did not immediately drop, but eventually it has dropped. And this is where we need to use risk management, because there are cases while it is overbought, it can continue going up, and that's where risk management is definitely necessary. Moving forward, we'll come back to RSI again on the live charts to see how we can apply it on a short-term momentum trade. Now, coming to the most interesting part of today is the Fibonacci. I am sure most of you all must have heard about Fibonacci either in your school or college days. For those of you who do not remember what Fibonacci series of numbers is, do not worry, it's very simple. Fibonacci numbers start with 0 and 1. You add your first number with the second number, you get your third number. In this case, you see over here 0 plus 1, you get 1, 1 plus 1, you get 2, 1 plus 2, 3, 2 plus 3, 5, 5 plus 8, 13, 13 plus 21, 13, 34, and it goes on to infinite. So these are known as the Fibonacci series of numbers. Now, how do these series help us in trading, which I will show you in a couple of moments. Let's understand why is Fibonacci interesting, or why is Fibonacci fun, or how does Fibonacci actually appear everywhere in the universe. If you look at the Fibonacci if you look at the Fibonacci, it's just a series of numbers. But when we are looking at the market do not move in the same series like how Fibonacci moves. Market moves in percentages, and hence it is very crucial for us to get the ratio from these numbers, which I will show you in a little bit. Again, fun fact, Fibonacci sequence, also known as the golden ratio, appears a lot in nature. Patterns such as spirals of shells, curve of waves, sea heads, pine cones, and branches of trees can all be described using the mathematical sequence. I'll show you a couple of examples on this. The fact that the things as large as spirals of galaxies and as small as a DNA molecule follow the golden ratio rule suggests that Fibonacci sequence is one of the most fundamental characteristics of the universe. Again, this is the theory bit of it. Let's look at the practical side of it. This the geometrical representation of the same Fibonacci. If it is very small on your screen, my apologies. But I think you can see the bigger numbers over here. It starts with 1 plus 1, you get 2 square, 2 plus 3, you get the fifth square, 5 plus 8, you get the 13 square, which matches up to the rest of these numbers, and it goes on to infinite. The spiral over here that you see is basically it is connecting all the corners of each of these boxes, which creates a spiral. We'll come back to that again. Looking at a tree now, usually you can do this experiment at home if you have a lot of plants at home. I would recommend that look at a plant which has fewer branches, so it's more easier to probably count the number of branches on that particular plant. You see in this tree also follows a Fibonacci series. The only reason it has to follow these series is because once the branches out from the main trunk, which is one big trunk of the tree, it branches out into two, and those two again multiply into many more such Fibonacci sequence in a series of numbers. The whole idea of a tree being put into this particular structure is that when the sun gives out light, that it provides sunlight on each of the leaves on the tree, and one does not overlap the other. Again, that is how the nature has been designed, and from noticing the Fibonacci sequence appears pretty much even on a tree or a plant in your house. Of course, there's a sunflower which we won't be able to get into the spiral of it, which also has the Fibonacci numbers in it. So much so, our entire universe, the galaxy, has the Fibonacci series in it. Remember the geometrical representation that I showed you, which again forms the same spiral in the galaxy that we are now living in. Okay, now those were the interesting facts about what Fibonacci series and where all Fibonacci series appear in life. Now coming to the finance side of it, how are these Fibonacci numbers actually going to help us? Are these numbers going to help us determine at what prices the stock can jump? Is it going to be the same series as Fibonacci? No. But like I told you, we look at return, we look at percentages in the market moment. If you notice, if you read any financials or if you follow financial news, they only talk about markets going up by a certain percentage or the market has dropped by a certain percentage. If you look at a stock like Tesla, they will always talk about how many percentage Tesla has gone up by for today, or how much percentage Tesla has dropped from last week. So it all has to do with the percentage, because your returns based is based on the percentage returns that you make from the invested value. So hence we need to get the percentage for us to understand how Fibonacci works. Now the most interesting thing over here is the key Fibonacci ratio is 61.8, also referred to as the golden ratio. How do we get 61.8? If you'll have your mobile with you, or if you have a calculator, you can quickly open your calculator and go back. I will take you back to the series of numbers. Right. So here are the series of numbers. If you take any of the number from the series, for example, let's say I take 144, divide that by the second number, that is 233, and multiply it by 100, you will get 61.8. You can do that. You can do the same thing with a higher number. You can take 6765 divided by 10,946 into 100, you should get 61.8. So what that means is, irrespective of which number you take the first number, divide that but with the second number, you should always get 61.8. And that is why it is known as the golden ratio. You take any series from your number and you divide. Over here you have an example, 8 divided by 13, you get 0.6153. Basically multiplied by 100, you get 61.8. Higher the number, you get closer to the 8 decimal. Again, 55 divided by 89, you get 0.618. Again, into 100, you get 61.8. Now this is the golden ratio. Now we understand 61.8 is a percentage, and that is something that is going to help us in the market. Now let's go to the slide where we implement this on the charts and see how 61.8 actually plays out. Now here we have the chart of Apple. I think this is going to be very difficult. Let me just go to the live screen. All right. So this is Apple. I'm just going to a monthly chart over here. I'm going to change my candlestick for now. Do not worry about any of these. Just let's just focus on Fibonacci for now. I'm looking at a monthly chart. I will make this slightly bigger so it's more visible. I hope everyone's able to hear me now, and I hope you are able to see my screen. If you all are having any issue, please drop in the message. All right. I'm guessing everyone can hear me. That's good. Okay, so we have our live chart over here. We have Apple that I've opened on a monthly time frame. Now, one thing that I would like to tell about Fibonacci is why is 61.8 crucial, or how is 61.8 significant, apart from the fact that we found out that if you divide any of the number with the second number following in the sequence, you get 61.8. Now just think of me as a person who has my height is, let's say for example's sake, my height is 100 centimeter from my head to my toe. Now my hip bone pretty much is 61.8 percentage long from my leg to my hip than my upper body. So the human body also is designed in a similar mathematical sequence. Now, of course, now you know in the sequence you have five, the number five that appears in Fibonacci. So 0 plus 1, you get 1, 1 plus 1, 2, 1 plus 2, 3, 2 plus 3, 5. So you notice that we have five fingers on both our hands. So there are a lot of things that the Fibonacci numbers actually signify even in a human body. I'm giving you this as an example so that when I draw Fibonacci on the chart, okay, keep that in your mind. Think of the length as one long body, and where does the hip point come for come in for that particular long body. I'll show you a couple of examples, you will get it more clearly. Another example I would give you is if you take a measurement of your arm till your finger, from your shoulder bone to your finger. Let's say the length is 100%, your elbow is 61.8 percentage length from your finger till your elbow is 61.8, and the rest is your arm from your elbow till your shoulder bone. Now again, if you think of it practically, our forearm needs to be a little longer so that we can lift weights. So what does my hip bone or what does my elbow actually do? It gives me the pivot point. Pivot point is something that we need. A pivot is always used in mechanics. You know, a pivot is always used to leverage, or you try to use pivot points to maximize, you know, your potential. So in the same way, our body, again, our elbow acts as a pivot so that we can lift heavy weights. Now, keeping that in mind, how do I apply that analogy on the market? When you apply Fibonacci on the markets, you always look at significant moves. Now, in this case, we see there was a significant move that happened a lot of times. You see a significant move happening over here. You know, the market picked up, there's a good momentum upward, and the momentum broke. So that was one significant move. Now this downward is also a significant move. After this downward curve ended, you see a new significant move begin, and you see another drop over here where the move ended. So every time you see the market, you look at the last last thing that has happened. Right now, after this drop, what we have seen is the market go up all the way from here to here, where this significant move has been ended with these two red candles. All right, so I hope most of you all are following me so far. Now, to make it simple, how do I use Fibonacci? I'm going to measure my height. Okay, let's assume this is my height starting from this point to this point, right? Now, you go to your technical tools, sorry, you go to your draw tools, you get Fibonacci. So Fibonacci is not in your technicals, it's in your draw tools because you're going to be manually drawing those lines. So you click on Fibonacci, and now we're going to measure the lowest point to the highest point. Let me just zoom this in so it's more easier. Okay. So now we see this was the lowest point, this was my highest point. If you have any questions while I am showing this, please do drop in the message so that I hope everyone is following with me. Now, if you see the market has moved on Fibonacci, you see a 0% here, a 100% here. So we see a 100% height. Again, think of the analogy of my height. You know, there was one long upward move before the drop came in. Now, when the drop came in, it came to a certain level before it started bouncing back up. And what level was this? If you go back on your Fibonacci, you will see it came back to 61.8. Let me make these bigger as well. So All right, I'm not able to increase the font. Let me just try that one more time. All right, I'm sorry, I'm not able to increase the font, but you get the idea. Let me do this again. So you're going to look at a significant move that began at a particular time and the bottommost point to the highest point. All right, I think there's some glitch on my platform. We'll just refresh and get back on it. All right. Again, sorry for the inconvenience. I think there was a lag in my system. Now it should be fine. I'll just make the fonts a little bigger so it's more visible. I'm going to close this and restart. Again, how to draw Fibonacci? You go to your draw tools. You find Fibonacci, it is there. You measure the significant move, bottommost point to the highest point, right? So this was my highest point. I'm going to zoom this in so that got zoomed in a little extra. Okay, bottommost point to the highest point. Now you see when the market went up, it reversed and it came back to 61.8%. Now you also see 50%, 38.2, 23.6, 88.6. Do not worry about those numbers at this point of time. Let's just focus on 61.8. If you're curious about how 38.2 came across or 23.6 came across, again, it is the same math. Instead of dividing your first number from the sequence with the second number, you divide your first number with the third number and you get 38.6. And similar, you divide it by fourth number, you get 23.6. And those are the Fibonacci sequence. But the golden ratio is still 61.8. One more way to put this across is, let's say we are looking at Apple. Okay, let's say you want to invest in Apple. You see the price is moving up and you do not know when to enter the market. Now at this point of time, Apple, if you look at it year on year, or at least if you see from 2009 onwards, once it makes a new high, it comes down a little bit, but after that it makes a new high, then it comes down a little bit. So like let's say if you wanted to enter Apple at $14, which was in 2011, that is not going to happen. The max at this point of time we might get Apple back down is at $90. So the stock is always on growing higher and higher. So we do not look at buying the prices back at the lower end. Let's assume we started, or you were an investor who just came into the market. Let me just make this a little bigger. Okay. Let's say you were someone who came into the market in 2017 and the prices are moving up. Now, of course, it is not wise to be buying a stock at a higher price unless you're going to be waiting for the next 5 years, so that in case you end up buying at a higher price, the price eventually comes back, especially when you're trading with a very strong fundamental company like Apple or Microsoft. Now, in this case, if you have patience, you will always wait for the price to give you a discount in the market. In this case, the price rallied all the way from $22 to $57, and then you see the price drop back to $37. Now it's like you getting the market price at almost a 50% discount of this particular rally, so you can enter into the market. Now let's look at what happened immediately after that in the next rally. You see the market made a new high starting from this bottom to this high. Okay, now if I zoom that in, market went up, market started dropping again. Now where did this come back down to? It again came back to 61.8 of this particular rally. So 61.8 is a significant level where you can enter. It's not just that, it also means you're getting the market, or you're getting to buy Apple at a much better price. Now, of course, these are all something that has happened in the past. What about the future? What do I look at doing at this point in time? Right now, when I look at the market has pretty much rallied all the way from here to here, right? So this is my new significant upward momentum. This entire move from here to here is my new significant move, which has been broken by these two candles here. So that means we can see the market is slowly retracing like the way we had seen earlier. Here once, here once. Now in this case, as an investor, if you're looking at buying Apple, what would be the best price for you to buy? And this way Fibonacci helps you. You take the lowest point to the highest point, right? Now you see in this case the market came down. It came till 131, that is on 38.2, but it still has not come to 61.8. If you are a long-term investor, you would wait for the market to come to 104, and that is where it would be a good level to start buying into Apple. Again, please note that technical analysis always discounts fundamental analysis. Now, in case there is a negative news for the markets and Apple is dropping because of those specific negative news, in that case, you should be cautious before buying it. You should know what is happening fundamentally for the market. But apart from that, if you're purely looking at technical analysis, you always wait for 61.8 following the Fibonacci rule. I hope so far understanding how to draw Fibonacci, how to measure where to buy is understood. If you have any more questions, please drop in the message. Perfect. Now, I think everything on Fibonacci is clear. Let's look at something what we can do on a short-term trading. Now, what I showed you was on a monthly trade. Now, let's say I showed you the chart of Apple on monthly time frame. That means we are looking at a longer time frame. Probably you are a person who are looking at a shorter time frame. Will the same example or will the same technique apply on a shorter time frame? Yes, it does. Now let's go to Apple. Let's go to a shorter time frame. Let's look at probably 30 minutes on Apple, right? Now, can you see on 30 minutes, Apple has given a lot of significant moves. Now, lower the time frame, higher the moves. When you go to a higher time frame, like let's say you go to a monthly time frame, you see few swings. When you come to a 30-minute time frame, you see more swings over here. But that's okay. Now let's look at last couple of swings that has happened. Let's measure this swing from this bottom to this high, right? Or rather you can take right from the bottom. In this case, it went up, it came down almost to 61.8, but it did not touch. So hence, if you're following the 61.8 rule, you will not be buying. But if it had to touch this point, you would take a buy order over here and the market moved up. Now we are currently at this level over here. This is the last move that has happened where the market looks like it's dropping. So in this case, on a 30-minute time frame, if the price comes back to 142, that would be a decision-making level for buying into the market. I have a couple of questions here. Okay, please. I have a question which says, please advise the best technique which helps to get profits during these downtrend market situation as Fibonacci not working out too much. All right. So Fibonacci does not only necessarily have to do with the uptrend. Fibonacci can be used even on a downtrend market. Now, whatever we did, like let's say at this point of time, we were measuring bottom to top, right? But what do we do on a downtrend market? That was a very good question. You do the opposite. You measure top to bottom, right? So if you measure this drop, this was my significant drop. If you see the market bounced back up to a certain level before it dropped again. So this again came back to 61.8 over here. Okay. Similarly, if you are looking at a downtrend market, you do the same analysis. Here's a drop, top to bottom. Okay. In this case, it almost, yeah, I think it pretty much touched 61.8 before the drop began. So if you're looking at a downtrend market, you can also make money by shorting the markets. For those of you who are not aware of shorting the market, in simple words, for now, I can say a shorting the market means you sell or you short the market without buying it. Meaning, very simple. Instead of buying the market, you take a sell. If the price goes down, you profit from it. If the price goes up, you actually lose on that particular trade. So that is known as shorting the market. So people who trade in the market, they trade on both direction. They buy the market, at the same time they also sell the market. So that is known as the shorting the market. I'll show you a couple more examples. Let's look at gold. Okay, gold again. A lot of people look at gold to be a good safe haven during times of uncertainties. Let's see if we apply the Fibonacci on gold. How will Fibonacci help us determine gold prices as well? If you want me to put Fibonacci on a specific instrument, please write it in the chat. I can put Fibonacci even on those, and we can look at how the performance has been. I've chosen gold at this point of time. So let's look at the first significant moves that has happened on gold. Okay, we see a very big move over here. So there was a good move here as well. This move was broken with the downtrend here. After that, there was a new move that began. Now you take the lowest point to the highest point. If you see, gold went up. Okay, from 2011 it started dropping. It came back to a certain level, consolidated at those levels, and bounced back up. And if you go back on the Fibonacci, you see again it was trading at the 61.8 region. Now, of course, this is past data. Let's look at recent moves on gold. Let's look at couple of. This was a move that happened in gold. I'll just zoom this in. Okay, bottommost point to the highest point, it came down to a certain level, bounced back up. Again, if you look at it, it's at 61.8, and this can keep moving up to every single move, right? You go back over here. This breached 61.8. However, it still held above it and moved above. From this point, it has moved all the way till here. Okay, now gold. Sorry, let me just get this straight. Yes. Now this is where we are on gold. Gold has moved up. It showed signs of weakness, but it's still on a sideways range. So till gold comes back to a lower level, for an investor, it would not be wise to do very long term on gold. But let's say you are a trader, you're looking at short term moves, you can always move from a monthly chart, go into a 4 hour chart. A short term chart will give you a smaller range, or even if you go into a 30-minute chart, 30-minute chart gives you a smaller range. So you can measure bottom to top. You see this level over here, 61.8. Then if you can measure top to bottom as well. So I'm just measuring this top to bottom. You see the market bounce back up. Again, it took resistance at 61.8 over here. Now the last move that has happened is pretty much this top to bottom. Now, till the prices of gold goes back up, you will not be doing any trades because this is the last move that has happened. So you always look at Fibonacci on the last move that has happened. I was showing you Fibonacci on historical moves, but let's try and do a couple of trades using Fibonacci on the current market or the live prices. Let me find an opportunity, probably SPX. All right, so we have SPX over here. I'm just going to change my candle style. So let's see SPX on a shorter time frame. I'm looking at a 30-minute time frame. I saw the last significant move that has happened on SPX is from this bottom to this top, right? After that, it has been a downtrend. Even if I make this 1 hour, right? You can see the prices have come to 61.8. So in this case, what would a trader do? Anyone who is looking at a short-term time frame will always look at 1 hour, 30 minutes, or it can also be looking at 5 minutes, depending on how many dollars it moves. Now that is where ATR and RSI helps us out. Let me come back to the ATR. Before that, let's look at the last move that has happened. This was the lowest point. This was the highest. Sorry, this was the highest point, and SPX has come to this particular point and reversed, right? Again, if you notice, it has taken support on 61.8. One very important point that I would like to make over here, 61.8 does not mean every single time it comes back to 61.8, it is going to work. There are good chances it can go below 61.8 and it can continue going down further. So this is where our RSI, sorry, our ATR and our other Fibonacci ratios is going to help us. Now let's look at this particular trade. If one had to take a trade, let's try and do a trade on this. You have an account value of $10,000. Let's say you invest $10,000. We're going to be buying at 61.8. The price is at 4105. Okay, now we know we need to buy at this price on this particular swing because we understand it's at 61.8. Now you have identified your entry point. Now the second most thing that we need to look at is your stop loss and your take profit. Now this is where ATR comes into play. You go to your technicals, go to studies. Let's go to ATR. Okay. Now, what does ATR tell you? I'll just give you a refresher on ATR. ATR means it tells us how many dollars can a given instrument move in a given time frame. Now, I'm looking at a 1 hour time frame, and I can see I have chosen 1 hour, and I can see ATR showing me SPX can move $20, about $18 to be precise, 19.32 at this point of time. Now, when you set your stop loss and take profit, I can set a take profit and stop loss very close by, right? I can keep a stop loss right below where I buy. Okay, but that becomes dangerous because it can come hit your stop loss and go away. Because on an average, SPX moves $20 in every single hour, right? So if I keep a stop loss this close by, that is surely going to take or that is surely going to hit my take profit. So on an average, I should make sure I keep at least a $20 take profit. Sorry, stop loss. Let me just make this a round figure. Okay, let's say you buy 10 units of SPX at 4105. Okay, now you need to keep a stop loss of minimum $20 away from the current market price, right? Now you have your stop loss and your take profit again $20. So you have your stop loss and take profit set based on the ATR. Now you can also set your stop loss and take profit based on Fibonacci. Okay, any questions on ATR? You can ask me. I will show you a couple more examples. So I think ATR will become very clear. Now we identified that you try and identify an entry point based on Fibonacci, but you use ATR to determine how much profit or how much loss you should be taking on a 1 hour time frame. Now this is 1:1 risk reward. You're going to be risking about $200 to make about $200. But if I use Fibonacci for my targets, I'm just going to close the stop loss and take profit for now. Let me use Fibonacci for my target. I'm going to measure this drop. Okay. I'm going to measure top to bottom and see where 61.8 comes. So 61.8 comes somewhere here. I'm going to put a take profit on 61.8 because every time a 61.8 comes, you see a potential reversal in the market. Stop loss, again, you stick to your ATR, 20 points. So in this case, your risk reward is 1:3. You're risking about $200 to make a $600 profit. You can also use Fibonacci to keep stop losses instead of ATR. Okay, in Fibonacci, after 61.8 comes 78.6, which I have not added. I'm just going to add that 78.6 before done. Okay, now in this case, you have entered at 61.8. You keep your stop loss at 78.6. Now, why Fibonacci is very simple to use is because Fibonacci is more about discipline. You do not enter into a buy trade until and unless you see it come to 61.8. That means there's a discipline that needs to be employed. And let's say it comes to 61.8, we take a buy at 61.8. We make sure we keep a stop loss at 78.6. Second discipline in the market. And of course, never keep a stop loss too close by. Value, let's say we are taking a risk of $280, and you keep a take profit of $80 on the upside. Now this makes it very bad risk reward ratio. So again, you follow the same rule of 61.8 for the take profit. Now, Fibonacci helps you maintain discipline, helps you maintain risk management, and it also helps you identify good potential entries in the market on both the buy side and the sell side. I have another question over here. Can you show Fibonacci on NASDAQ 100 or SPX chart? Okay, I think we were already doing it on SPX. So that is where Fibonacci is going to help us with. I will show you one more example. Probably if you get a live trade, that would be great. In the meanwhile, if you all have any other questions, please let me know. Now, if you all are looking at a long-term time frame, now most of you who are in the market understand that S&P 500 is the broader basket of the US markets, and it can help you identify where the market is currently heading, or where can the market head into in the near future. Let me go to a monthly chart on SPX 500. Let's see where we are in the current market cycle. This was the market crash that happened when the pandemic hit. Then market recovered. Right now, Ukraine, Russia war, inflation, markets are dropping. Okay. Now the question is, if you're an investor, or if you're someone who's looking to trade or to invest, or trying to identify when to buy the markets, let's use the same thing that we did. Take your Fibonacci, measure the lowest point to the highest point. Okay, I'll make the fonts bigger. Now again, I'm not looking at a short-term view, I'm looking at a very long-term view. Now in this case, 61.8 is when SPX drops to 1000, sorry, 3200 levels. Where are we at this point of time? We are at 4150 levels, right? Now, one more good thing about Fibonacci is you can also trade within the range. Now, let's say the market range is between 23.6 and 38.2. These are buying and selling opportunities as well. I'll just make this into a weekly chart, right? You see, it came down to 38.6. It came back to 23.6 over here, 38.2 and 23.6. This is a level to short. This would be a level to buy. If these levels break, the next target SPX can drop is to the 50% mark, which is this level. So this will become your trading range. Just to give you an example, I'll just draw this. This could be potential trading range. If it breaks below, then this could be your potential trading range. Then let's say if this breaks below, this could be your potential trading range. It can also go back, retest these levels. Again, this could be your trading range. And your ranges will always be within this Fibonacci series. So that means you know your crucial levels. In this case, Fibonacci shows you your crucial points. That is 4186 or 4200 is a crucial point. At the same time, 3800 is a crucial point. 3500 is a crucial point. So at depending on what time frame you're trading on, or what type of objective you have for your account, these ranges are very important to be watched out, because it's not just you and me who are looking at these levels. These are the levels the entire world is looking at. Hence the support and resistance always holds. In this case, if you see, the market dropped to this level and it bounced back up, right over here. This particular, let me mark that, this particular bounce back up over here. So this was a potential support where buyers took advantage to go back up, right? Now I will measure the downside, top to bottom, right? Within that range. I'm just, if you notice, it jumped back up. I'm sorry if it's too muffled over here. I'm just trying to zoom that in. It bounced back up, went to 61.8, and again it started dropping. So there is Fibonacci. within a Fibonacci, and it can go on like even to a 5 minute chart. Then I can, I started this with a monthly chart. Now I can go to a daily chart. Right now, this is how my daily chart looks. Okay, I can zoom this more into a 30-minute chart. Now this is how my 30-minute chart looks. So now I know on a 30-minute chart, if it goes back to 4,186, it is a good level to start shorting again. If I measure this top to this bottom, okay, if you notice again 61.8 comes in pretty much the same region. So these Fibonacci series can keep continuing as it goes into a smaller time frame. But the most fundamental rule to always remember, when you draw Fibonacci, always look at the last significant move. If I'm looking at a monthly chart, my last significant move was this entire move over here from here to here. This move was broken down by this move that is happening right now. Okay, and you do the same thing. If you go to a 1 minute chart, let's go to a 1 minute chart. Let's look at what is happening on a 1 minute chart. Right now, there is a significant move that has happened or still happening from here to here. I will not measure this move until and unless I see the market dropping back down. So once the market starts dropping down, is when I start measuring. Whoops. Okay. I think that was too small a time frame. Uh, I have a couple more questions. Okay, someone wants to know how to do shorting technique during a downtrend. The logic of a shorting technique is pretty much the same logic as buying into the market. I think for this particular question, we should be sitting one on one. But if you still want to know how to short the market, you will do exactly opposite of what you will do when you're buying the market. On while you're buying the market, you'll always look at the drop in the market to buy. Okay, when you're shorting the market, you'll always look at. Sorry, I think there is some glitch with the platform. I'll just try and open this. While you're shorting the market, you'll always look at. Sorry, when you're buying the market, you'll always look at dips in the market. Okay, while you're shorting the market, you'll always look at the rally in the market. So in this case, the market has rallied. Let me just try this one last time. Okay, I think this should be good for now. Yep, perfect. Coming to maybe a 2 minute chart, we see this rally. I will not measure this rally, that is my lowest point, to the highest point until a downtrend begins. In this case, let's say in the next couple of minutes, we see the market dropping. Let's say the market at this point or maybe from here starts dropping a little bit. Okay. Then I will start measuring my Fibonacci once I see the drop. So in this case, it will be I measure the lowest point to the highest point so that when it drops back to 61.8, okay, this is my 61.8, I will take a buy. Okay. For those who are looking to short the market, it is vice versa. I will show you how shorting the market would look like. Crude has been rallying quite a bit. So I'm just going to open crude. Oops. Okay. So crude rallied. Now crude has come down. Now for you to short the market, you will measure top to bottom. Okay. And when the price comes back to 61.8 over here, this is where you take a short position, you keep a stop loss at 78.6, and you will keep a take profit at 61.8. So you do the exact opposite of what you would do on a buy market. Again, the concept might be a slightly tricky to understand shorting the market for those of you who are not very familiar with shorting markets. Do not worry about shorting or buying the markets. At this point of time, just to summarize today's session, learn how to use Fibonacci, learn how to draw Fibonacci. I would recommend, if you've not traded before, take a demo account, try and get your drawing of Fibonacci right. Again, you find the significant move, measure that move, monitor what happens on that particular move, and try and take a couple of demo trades on that move. If you need more in-depth analysis, if you want more in-depth hand holding, you can always call one of our consultants. If you already have an account with us, you can come sit with your consultant and he will teach you more in depth. Today, I was just trying to lay a foundation of how to identify, more importantly, how to draw Fibonacci and how Fibonacci actually helps you keep a disciplined trading methods for your whether you're doing a short-term trade or a long-term trade. It gives you those levels where you can enter into the market, but at the same time, it also advises where you should be keeping a stop loss and take profit. More importantly, risk management is the key. And along with this, we have already overshot the time for today. I know we do not get too much into RSI, but you can use RSI pretty much the oversold, overbought position using Fibonacci and try and take some trade advantage. I will just show you an example on RSI before we just wind up. This is our crude oil West Texas, basically crude oil which has been rallying. Let's look at Fibonacci. We see a significant move that picked up from this point pretty much till here. You can take the lowest point as well. Okay. Now I have measured this particular rally. Crude has come back to 61.8, right? You can see over here, it has come to 61.8. Now, if you want a double confirmation, if you should be buying crude at 61.8, you can go to RSI. Remember, RSI is an oscillator which oscillates between 70% or 100% on the upside, or 0 or 30% on the downside. Our idea was every time it comes to oversold territory, there's a good potential that the prices can start reversing back upside. Now, with a combination of oversold and 61.8, you get two confirmations to take a possible buy in crude oil. At the same time, like I told you, the prices, just because it is at oversold, that does not necessarily mean the prices have to jump back up. At the same time, just because the price is at 61.8 does not mean the prices has to jump back up. There are high possibilities it can jump back up, but there is also good possibility it can continue dropping and probably the trade fails and it continues going down much deeper into the market, right? So this is where your risk management comes into place. You buy at 61.8, you keep your stop loss at 78.6, and on the reverse, you keep a take profit at 61.8. So you have your discipline in place, you have your signals based on Fibonacci, you have your signals based on RSI. You also have ATR, which shows you how many dollars it can move, just to double confirm your stop loss and take profit. These are a few basic methods. If you use it with discipline, which would help you to become a more successful trader. But of course, it comes with practice. It also comes with a lot of guidance to identify these trades. If you need any more assistance, I would encourage you to get in touch with your consultant. Probably you can come sit with them and go more in depth, trying to use these indicators to identify trading opportunities or investing opportunities for yourself. Thank you all so much for your patience, and I'm really sorry about the audio glitch that we had earlier. I hope this session was informative for you. I would really appreciate if you can drop in your message, your suggestions, if you have any other topics that you want me to cover in the future, and if you can drop that in the chat box, I would really appreciate it. We look forward to seeing you all either in our office in the near future or in the next webinar. Thank you again for the time. Hope to see you all again soon. Thank you. Take care.